Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Banks are the dominant pillar of Africa's financial system. In nearly every country on the continent, banks account for more than 80% of total financial sector assets, dwarfing insurance companies, pension funds, and capital markets. This presentation examines the banking industry as a whole, before drilling into diversified banks and regional banks in companion videos. We focus on the multi-billion-dollar institutions that define the competitive landscape, the regulatory frameworks that shape them, and the structural forces that will determine their trajectory over the coming decade. Total banking assets across the African continent now exceed $980 billion United States dollars, distributed across roughly 900 licensed banks operating in 54 distinct jurisdictions. The weighted average return on equity for the sector was approximately 12.5% in 2023, comfortably above the global emerging market average. The number of deposit accounts, including mobile wallets, has crossed 3.7 billion, illustrating both the breadth of customer reach and the depth of account duplication across institutions. The banking industry is structured into two principal segments. The first is diversified banks, large, multi-product, multi-jurisdiction institutions with total assets above 20 billion United States dollars. Examples include Standard Bank Group, FirstRand ABSA Group, Nedbank Atajara Wafa, Bank of Africa, and Access Bank. The second is regional banks, institutions that dominate a single national market or sub-region, with a tighter product set and stronger customer intimacy. Examples include Commercial International Bank of Egypt, Capitec Bank of South Africa, Zenith Bank and Guarantee Trust Holding of Nigeria, and Equity Bank of Kenya. The two segments compete head-to-head in many markets, but they operate with very different cost structures and strategic priorities. At the top of the pyramid sit 8 banks with total assets exceeding 20 billion United States dollars each. Standard Bank Group leads with 172 billion, followed by FirstRand at 108 billion and ABSA at 74 billion. Atajara Wafa of Morocco and the National Bank of Egypt anchor North Africa. Commercial International Bank of Egypt and Zenith Bank of Nigeria represent the regional bank segment at this top tier. Together, these 8 institutions hold more than $600 billion in assets, the majority of the entire African banking system. The regulatory architecture is national, with growing regional coordination. Basel III capital frameworks have been adopted in South Africa, Nigeria, Egypt, Morocco, and Kenya, with common equity Tier 1 ratios typically ranging from 12 to 16% across the major banks. Most central banks require minimum statutory reserves of 5 to 15% of deposits, materially higher than in developed markets, and a structural drag on net interest margins. Forward-looking expected credit loss provisioning under IFRS 9 has tightened post-pandemic, with the cost of risk normalizing to between 1 and 1.5% across the major systems. The Collaborative College of Supervisors has improved cross-border oversight for Pan-African groups, and stress testing for sovereign, currency, and climate scenarios is now mandatory in the largest markets. 2 banking models dominate. The universal banking model practiced by Standard Bank, FirstRand, ABSA, Atajara Wafa, and Access Bank combines retail, corporate, investment, wealth, and insurance distribution under one roof. It capitalizes on cross-sell and operating leverage but carries complexity, higher compliance burden, and exposure to wholesale funding markets. Net interest margins typically run 4 to 6%. The specialist banking model practiced by Capitec, Equity Bank, and most microfinance banks runs a narrow product set at very low cost. Net interest margins can exceed 10%, and customer growth drives returns rather than product cross-sell. The specialist model is highly sensitive to single market regulatory shifts, but offers superior return on equity in stable periods. Asset quality is the single most important metric for investors in African banks. Across the major banking systems, non-performing loan ratios at the end of 2023 ranged from approximately 3% in South Africa and Morocco, to 4.5% in Egypt, to roughly 5% in Kenya, to elevated levels of 15% or more in Ghana and Zambia following sovereign debt restructurings. Coverage ratios, the proportion of non-performing loans covered by provisions, typically range from 70 to 100% in well-managed systems. Investors pay particular attention to banks that maintain coverage above 100% through cycles, as this signals conservative risk management. Digital channels now carry the majority of African banking transactions. Digital transaction share in the major markets exceeds 78% of total bank transactions. Mobile money transactions processed across the continent exceed 2.1 billion per month. Digital-only banks such as TimeBank, BankZero, and Kuda operate with cost-to-income ratios of 4 to 7%, compared with 50 to 55% for legacy universal banks. Smartphone banking penetration has crossed 65% in the major markets, and this trend will continue to compress the cost of serving low-balance customers while expanding the addressable market for credit, savings, and insurance products. 5 cross-cutting strategic issues will shape every African bank over the next 5 years. First, sovereign exposure limits. Regulators are tightening caps on single counterparty exposure to governments, forcing banks to diversify loan books toward the private sector. Second, currency risk management. Banks with strong fee income in stable currencies and tight asset liability management will outperform through cycles of naira, pound, and kwacha depreciation. Third, environmental, social, and governance and climate risk. Climate risk assessment is now embedded in central bank supervision in South Africa and Kenya, with other markets following. Fourth, open banking. Frameworks are being introduced in Nigeria, Kenya, and South Africa, opening the door to fintech-driven product innovation. Fifth, talent and technology investment. Banks investing more than 8% of revenue in technology are pulling away from peers on digital adoption metrics. In summary, total banking sector assets across Africa are projected to exceed $1.3 trillion United States dollars by 2028. Universal banks will continue consolidating cross-border, while specialist digital banks will capture the next 100 million customers. Net interest margins will compress as competition intensifies, but fee income from payments and digital services will partially offset that pressure. Climate stress testing and sustainability-linked lending will become a competitive differentiator within 5 years. The banks that scale digital infrastructure, manage sovereign and currency exposures prudently, and embed themselves in cross-border trade flows will deliver outsized returns. Thank you for watching this overview of African banks.